Good evening, ladies and gentlemen. Welcome. I'm your host, Dan Theox, Senior Vice President of Investment Banking. Welcome back to yet another investor briefing where today we'll be looking at the NCB Financial Group's Q1 results. And on the panel, we're joined today by Robert Amelia, the Group CEO. Hey, welcome, Robert. And for the first time, we've got the Group FC CFO. Welcome. Good to have you, Malcolm Sadler.
Thank you.
I guess Angus is at carnival partying or something. So, hey, Angus. Well, welcome, gentlemen. We'll also be joined later today, hopefully, by our group CEO for Mayberry, Patrick Battier. But in the meantime, I think we'll get started with the folks we have here today. If you're a fan of the content, please don't forget to subscribe to our YouTube channel. Also to hit the bell to stay up to date with the channel. And we upload content just like this, just about once per week. Also, if you want to embark on your very first investment journey, take that first step with Mayberry, of course. Follow us on social media to learn more about how you can get started today. And don't forget, we're going to have a Q&A segment at the end of the program, so make sure to submit your questions well in advance so we can try to address them closer to the end of the program. Okay, so let's talk about Malcolm Sadler first, since it's his first time here. He's the group CFO, as I said before, and he's pivotal in ensuring NCBFG's financial strength and strategic focus. He oversees the financial planning, reporting, and performance management, ensuring all align with the group's objective. His expertise extends to monitoring risk and budgetary goals, contributing to key management committees and the subsidiary board. He's also a member of the American Institute of CPAs, and his leadership underpinned the group's stability and operational efficiency. As a side note, he's been with the group for over 30 years. He's a UE graduate, has a degree in accounting, and is just a great guy. Robert Amelia, you guys know, he's been on the program before. He's got over 35 years of experience spanning a multiplicity of fields, and he's the group CEO for NCB Group, and he brings a wealth of experience from overseas, and it's great to have you on board the group. I think he's a great guy. He's a founding partner of Portland Private Equity. He has a proven track record in managing high-value investments, and he also chairs several boards, including Guarding Holdings Limited and NCB Jamaica, leveraging his CPA experience. He also has a Bachelor of Commerce with a high distinction from the University of Toronto to lead with the financial acumen and foresight. So great to have you guys both here. Trust me when I tell you, folks, these guys are more than capable. Rob, Malcolm, great to have you both here.
Thank you.
How we're going to do this today is Malcolm's going to first of all kick off with his overview as to the performance for Q1, and then I'll follow behind him and do my little thing, and then we'll open up to some Q&A amongst ourselves, and then I'll look at the Q&As that we have online. So Malcolm, let me kick it over to you.
Yes, thank you, Dan. Good day, everyone. It's great to be here, and thanks for joining us. I'll just quickly take you through the performance and the financial position for NCB Financial Group Limited for the first quarter. That's December 2024. That's our Q1. I'll just quickly take you through our performance. The group reported consolidated net profits of 5.1 billion for the quarter, and this was approximately 73% higher than the comparative quarter of December 2023. Profits attributable to the parent, or attributable to shareholders of the parent, was 2.6 billion for the quarter, and that was more than 100% higher than the comparative prior quarter. Also, when you compare our Q1 with the last quarter of the previous financial year, which is Q4, September 2024, we're also ahead in terms of consolidated profits by 48%, and ahead in terms of attributable to the parent company, 72%. This is driven by operating income of 38 billion, which increased by 13% over the comparative quarter. Our results in terms of our banking and investment activities, revenues from that stream increased by 9%, mainly driven by an increase in our net interest margins and gain on FX and investment securities, and also additional income from sale of fixed assets and rental income. Our insurance business as well recorded a 21% increase in revenue over the period. And in terms of insurance service results, which is the net insurance revenue net of expenses, that also increased by 21%. when we look at the operating expense side, operating expense was approximately 28 billion, and that increased by 6%, mainly due to us booking some additional operational losses in Q1 and also additional expenditure on software support and maintenance during the quarter as well, increasing by $1 billion. The current quarter also includes the asset tax, which totaled 2.7 billion for the quarter, which is booked in full, and that actually increased as well by 6% quarter over quarter. In terms of our performance metrics, our return on assets, annualized return on assets, increased to 0.89% from 0.54%. Our annualized return on equity increased to 6.17%, and that's up from 3.27% from the previous quarter, from the comparative previous quarter. Our cost to income ratio trending in the right direction. It's currently at 73.6%, and that's coming down from 81.44. And our earnings per share at $0.09 for the first quarter compared to 52 cents for the comparative quarter. We operate through 7 segments, and for Q1, 6 of those 7 segments had improved performance compared to December 2023. Our life, health, and pensions segment operating income total 8 billion, and that's an increase of 28% compared to the previous quarter. Our treasury business as well, treasury and correspondent banking, up 13%. General insurance up 18% as well. Our corporate and commercial banking up 11%. Our payment services up 22% for the period, and the only segment with a decline was our consumer and SME banking segment, which reported a loss of 231 million for the quarter compared to 150 million for the comparative quarter. Wealth and asset management and investment banking also improved by almost 600%, 575% to be exact. And that was driven mainly from gains on investment instruments, both unrealized and realized, together with improved fees during the quarter as well. In terms of our total assets, our consolidated total assets, as at December 31, 2024, totaled 2.3 trillion, and that's actually a 4% increase compared to December 2023. We'd have seen higher levels in terms on our asset side in terms of cash in hand and balances at the central bank, which increased by 38%. In terms of investment securities, which total 1.2 trillion as at the end of December 2024, an increase of 3%. Loans and advances also increased. The total, in terms of our total portfolio as at the end of December, was 616 billion, and that's an increase of 2%. Customer deposits also increased on the liability side. The total was 781.3 billion, and that's an increase of 3% compared to December 2023. Equity attributable to shareholders also improved, totaled 168.2 billion, and that's an improvement of 6% over December 2023, and that's mainly driven by retained earnings growing. On the capital side, in terms of our regulated entities, all our regulated entities met their minimum capital requirements, and entities that has a liquidity coverage ratio requirement all were ahead of the minimum requirement with buffers above what the regulator is asking for. So overall, that summarizes the performance of the NCB Financial Group for the first quarter, both in terms of performance and our financial position as at the end of December 2024. I'll now hand it back to Dan.
Thank you, Malcolm. I appreciate that. And the results are They're pretty interesting. I'm going to say that. We're going to get into that. We're going to talk a little bit about that. Folks, I want to show you our perspective of the performance, just sort of tying it back to the market, and I'll talk a little bit about market expectations and so on and so forth. On our first slide, and I'll try not to repeat the stuff that Malcolm covered already. So first slide, I just wanted to sort of sit in, and so you see again 114% improvement in the net profit attributable to shareholders. It's $2.6 billion compared to $1.25 billion, and that translates into an EPS of 1.02. Interestingly, stocks at $47.62. And when you look at the trailing earnings, which is $14.7 billion, and you work out the PE ratio, you get a PE ratio of about 8.35 times. Interestingly, we just talked about $2 trillion in assets.
Yes.
When you look at the price to book of NCB, it's 73 cents. So that's to say at 47.62, the stock is trading at a discount to book. And I mean, that's really unusual, guys. Most of the banks will trade at 1.2, 1.4 book. So if you look at a Scotia or any of the other banks, you're not going to see other banks trading at a discount to book. So this is really unusual, and it's why I think the stock is relatively cheap, and well, I still think NCB is a great buy. Now, the performance itself for the quarter, I'll just make two comments. We spoke about annualized ROE of 6%. I think that's a little bit, below market and expectation, but we talked about it off air. NCB books the asset tax all in the first quarter. So the 2.7 billion, you took that all in the first quarter. And that's, more than half of the profit that you made.
Yes.
And so if you made that adjustment, you could see that the annualized ROE would look more like 12%.
Yes,
More than
digits.
half your profit. You took the hit and the asset tax, which is not going to repeat itself in the next 3 quarters. And so when you make that adjustment, I start to go, okay, I get it. So the ROE is going to be better in subsequent quarters. The earnings going to be better in subsequent quarters. So this $2.6 billion quarter, while being 114% better than same quarter last year, my listeners who've paid attention to the program, and Angus, who I told I would slap, know that we kind of expect NCB to be doing at least $4 billion a quarter, Malcolm. That's kind of, as the analyst, what we expect. And that's just based on historical trends. When we look at the last 5 years and your average quarterly performance for NCB, you're going to get about $4 billion a quarter. This is a company that, when it's really running, will do $20 billion a year attributable to shareholders. That's our expectations. Now, at that kind of run rate, it's like a $90 stock when the PE is 10 times. And so, ultimately, I feel like once we see you guys doing a minimum of 4 or 5 billion a quarter, we think interest rates have kind of bottomed out now. We saw yet again another 30-day auction, Malcolm, closing at 6%, $40 billion uptake in a 30-day GOJ CD at 6%. It's over $130 billion in 30-day CDs at 6%. They're barely keeping up with inflation. Same for the 2-year CDs, rates like 6.3%. So we fully believe from the Mayberry perspective that we're going to see some fixed income assets switching back into equities, and some of the big pension funds in particular who were sitting down and earning 8, 9, 10% on government paper, that rate's now down to 6%. So I believe we're going to see a good result for the stock market in general. I believe PEs are generally going to move from the main market average of about 9 times to 10 or 11 times over the next 2, 3, 4 quarters. And I do believe when the big pension funds are choosing entities to invest in, there are literally only 3 or 4 that I think are super cheap. NCB is clearly one of those blue chip investments that I think folks should be looking back towards. I can't think of another company in Jamaica that will boast even having $1 trillion in assets, let alone $2 trillion. That's listed on the stock exchange, by the way. That's just a rare thing to see. I was at JPS. I think they have $1 trillion in assets. It's not listed, so there are very few opportunities, I think, out there in the market, folks, where you're going to find a company that's trading cheap, is a leader in its space, historically delivers really, really great results, and is now trading at a price to book of 73 cents. Doesn't really make sense to me. And so here at NCB, we're going to keep buying the stock because we fully expect that, over the next 2 to 4 quarters, we're going to see more the price moving back up. And I personally think in the next 12 months, this stock is going to be back at minimum, say, $75. And then ultimately, over the next 24 months, I see it getting back to $90. So that's my perspective as to where I see the stock going, folks. And we're going to do some Q&A. Let me just cover the next two slides. I mean, it's, you know, NCB is just a great company. And I do think as the economy of Jamaica grows and does well, they're only going to do better. So as we reduce the debt to GDP, as interest rates trend down, as money market supply increases, this bank's only going to do better. So there it is. You see sort of the performance for the last couple of quarters. We had that one quarter. You got to go way back, and I'm going to call it. This is me dubbing it. Stephen Jackson, don't misquote me. This is the. I'm going to call it the Patrick and Dennis quarter when they exited and they had that $8 billion loss. That doesn't happen. Won't ever happen again, in my view. And what we expect to fully happening is to see them consistently doing $4 or $5 billion per quarter. Next slide shows the trading in the stock price. Stock prices trended down from the APO at 65. It trended down to 60 to 50. Now it's at $47. Now, I bought NCB 7 years ago at $90, and I was very happy with my purchase at $90. I watched it go to 140. I watched it trade at 150 for 2.5 years. I watched it touch 200 for a little bit. Then it came back to 150, came back to 130, it came back to 100. It dipped to 90. Then it dipped to 65. I bought more. Dipped to 50. I bought more. And now it's at 47. Now, I personally can't buy more because I've hit my own concentration risk. NCB makes up, roughly 18% of my total personal portfolio. It's not a $26 billion portfolio like MJE, but it's not a small portfolio either. But I still love the stock, and it's still my number one favorite pick when I'm making recommendations to high net worths or pension funds who we look at their portfolio and they're looking to get recommendations on what stocks, should they buy. NCB is one that you guys should be overweight on because I'm telling you the performance is only going to get better. And I'm going to leave it there before they think this is a paid ad. This is an independent assessment of NCB by Mayberry. We love the stock. And we like the management team. Malcolm, it's great to see you in person. Rob, it's always great to see you. And Angus, wherever you are, hopefully not in the middle of Carnival, come back because we're looking to see you guys do a lot of work in the capital market space. And with that, Rob, I want to just jump into a couple of questions. It's not going to be all praise. I wouldn't say concerns, but I do have a few questions. So let me open up with the what's happening with the the impairment adjustment. We saw an increase in impairment adjustment. What's happening with NPLs in general? I mean, still at 4.1%. You read 24 billion and it sounds like a lot, but it's 4.1% of your portfolio, and I think that's quite reasonable. But we did see a jump in the impairment adjustment. You want to just talk us through that a little bit? Why we shouldn't be nervous about that?
Sure. So on the impairment piece, our credit quality overall is pretty good. We had really there's one particular loan that we wrote off, and that started to take the impairment up. But it's, for the most part, our loan portfolio is in pretty good shape. But as you know, some corporate loans turn out to be, or real estate type loans turn out to be lumpy.
Yeah.
They're chunky.
Yeah.
And so when you have to, when you take a larger write-off on it, then it jumps at that time. So that would be on the credit impairment side. On the
NPLs, 4.1%.
yeah, little on the high side, but I'd say again, as we look at it, still nothing that we're really concerned about, and a big part of our loan book is secured.
Right.
The vast majority of our loans are secured, and so while the NPLs may run a little high compared to, when you look at it compared to some other financial institutions, because so much of our loan book is secured, the actual at-risk amount is much lower.
Got it. And I appreciate that perspective because I did see the movement in the e-sales, but the NPLs were pretty firm, and so I figured it might be some kind of one-off adjustment. Let's talk about efficiency, Rob. So we see some improvement there in the cost to income. going from 81% to 73%. But I still think there's some room for improvement, I would imagine.
Yeah. So,
What are your expectations for next year?
so on the efficiency side, I'll say we talked about this last year, over the last year, Dan, and as you talk about the 4 billion per quarter, and just to put it into numbers, this quarter, if you had normalized for the asset tax, would be around 4.5 billion, right? And really, we should be about a $5 billion per quarter company, and so on the efficiency side, what we did right at the beginning was we took out the very lumpy, chunky costs, exec overhead, consulting, investments in startups, that kind of stuff. I'd say we're just getting started now on the actual real productivity efficiency side.
Right.
And so that'll come in a little slower, but you're seeing it as kind of numbers like our income growing 10% and cost growing, even with some extra operating losses, about 6%. So you're just seeing that cost to income, we're going to get that operating leverage in the business, and the efficiency ratio will improve. But that's really a story that's just getting started. Most of the improvement that we've seen right to date has been the really big things we did at the start.
Good deal. Falling trend in interest rates, is this going to be good for the bank or bad for the bank? What's your perspective on that generally and how that impacts the business?
So this one actually throws people off because of the lag that exists.
Right.
So we are still in a position where we have not so our book, our asset book has an average life of about 5 odd years. So it takes about 5 years, maybe a little bit less than that, for the asset side to reprice as interest rates went up. So interest rates went up dramatically, and we are just starting to actually catch up on our asset side, catching up to the fact that our liability side of our balance sheet moved up quicker.
Right.
So our spreads compressed. The asset side is just starting to restore, while in the market, short-term rates are coming down. So we should go through a period where our asset yields will actually continue to rise a little bit, while our cost of funds should start to go down, for the same lag effect that the timing of the asset and the liabilities repricing is different. So short answer is it should be a good thing. It's a tailwind for us, and we're as our net interest margins normalize, and then the actual benefit of declining rates on the capital markets, that's still to come.
Got it. Speaking of declining rates, capital markets, I'll give you a free ad. You guys are trying to raise $5 billion in the market now, if I got that right. You want to talk a little bit about that? What's the purpose of that? Is it just refinancing? Could you speak a little bit about that capital market raise that you're currently looking at?
Sure. So we're the capital market raise we're doing right now is corporate debt. And at the NCB Financial Group level, we have our corporate debt, and when you think about that $2.3 trillion of assets that we have in our business, gives you a sense of the scale.
Yeah.
On the other side of that, of course, we've got corporate debt, and so we're almost always in the market, coming back from time to time, basically just rolling over, refinancing maturities that are existing. Now our debt is spread, for the most part, it's Jamaican based, but we actually do have our debt spread across other markets as well. So sometimes it may look like it's not a rollover here, but really it's a refinancing of debt that's maturing in another market. And other times we're raising money in other markets to refinance debt in the Jamaican market. So right now it's just a refinance. On the overall strategy side, our goal is to reduce our debt. So we have, in our debt management, we want to reduce our debt by selling off some non-core assets. At the same time, we want to lengthen out the maturity profile of it, and we would like to diversify it across multiple markets. All of that just to keep the debt profile very, very stable and very staggered, if you will, and diversified.
Yeah, that makes sense. So from the capital market side, what we're saying is those interest rates are likely to come down, but over the next couple of quarters. So you're doing what you need to do to refinance what you have. You're not increasing your overall debt, book of debt. You're just sort of continuing to roll what you have, and it's just another way how you fund the business.
Yes, exactly.
And that's important because I've had a few persons who sort of misunderstand that, right? And they might conflate issues with NCB trying to raise equity in an APO versus just sort of rolling over debt. It's just the way you fund your business. And again, with $2.3 trillion in assets, this is really a very small debt raise relative to the total assets. And then, as Malcolm said, the business continues to meet all of its regulatory requirements in terms of capital reserves, adequacy ratios, etc. In fact, this bond is rated, I believe, or the bank itself is rated. I think I saw some ratings by Carrie Chris or
We're rated by Carrie Chris,
Yeah.
rated by S&P and
Right.
Fitch.
Fitch.
The bank is rated same as the sovereign. What's it? Double B. Malcolm, double B.
Minus.
Double B
well,
minus.
same as sovereign.
Yeah,
Yes.
same
Okay,
as
wow.
same as the sovereign. In fact, it's capped out by the sovereign.
It would be.
Actually,
It would be.
It cannot be
and-
rated above the
Cannot
sovereign.
be
yeah,
rated above the sovereign. So
yeah.
as the sovereign's rating looks to improve over the next 2-3 years, then you guys might tag along with that
Yeah.
as well too, right? Good deal.
And NCB Financial Group just trades one notch below that
Yeah.
at single B.
That's impressive. That's really impressive, actually, when I think about it from that perspective. Good deal. All right, so I'm going to start picking up 1 or 2 questions online in a few minutes, folks. I do see them queuing up. And let me take a shot at the first one because it's more of a capital markets type question. And so somebody's saying, we hear about the improvement in performance, why doesn't it reflect in the stock price? And so I think actually, guys, that's just a bit of market perception, right? And oftentimes perception does vary from reality. So the fact is it's the largest, most successful bank, certainly in English-speaking Caribbean. And the fact is they've just gone through major restructuring. I mean, those are facts. The results speak for themselves. But on the perception side, I think the market's maybe still just waiting to be convinced, right? And I also think maybe there was some unusual pressure on the sell side, and I think that's now gone. And so that's why I think the stock is very cheap. So when we just look at the facts and compare them to any other bank or financial institution or conglomerate in the Jamaica Stock Exchange market, we're saying the stock is very cheap, both from a PE perspective and from a price to book perspective. And I think it's just a matter of time before the market figures that out. And until they figure it out, here at Mayberry, we'll just keep buying the stock. And I hope you guys will too, because we're going to come back in 3 quarters time and you're going to go, I remember when I could have gotten NCB for $46, right? I don't think that's going to last for very long. But thanks for that question. Answered Ramtran. Thanks for that question. I appreciate that. Next one coming in from Limitless Podcast. Hey, Limitless, I think that's you're right. Will MJE start buying back NCB shares? So my chairman isn't here today. I can't answer that question, but I can tell you here at Mayberry, MJE, we do like the stock. And so if I were to guess, I would say, yes. I would say yes. And especially now that we've looked at the quarter's results, and Rob's very clearly explained that if you made the adjustment for the asset tax, they have in fact achieved that sort of 4 billion minimum hurdle. So I think the stock's definitely cheap. I can tell you now, you can't get it to buy. There's nobody who's going to be selling it at less than the 45, 46 space. And those guys who have it and even are interested in selling it aren't going to sell it cheap because they know the value of NCB, and I'm inclined to agree with them as well too. So I certainly look forward to seeing results, Malcolm, next quarter and having you guys back again to discuss it, because I think the market's going to catch up with it. So Limitless and Answered, yep, we love the stock. I wouldn't be surprised to see us buying some again. Unrelated, I'm not conflating the issues. Here at Mayberry, we just also closed our own debt raise. We're trying to raise $2.3 billion. We upsized that by 50% to $3.1 billion. So, maybe chairman has some dry powder. Maybe he'll decide to use it to buy $1 billion of NCB. I don't know. It's the kind of thing he does. We'll see what happens. Only time will tell. But we love the stock here at Mayberry. Russell Campbell says, NCB stock price is discounted, so don't wait until the big news or better dividend to buy. The sell down is over. So thanks, Roswell, for that. And I don't know who Roswell Campbell is, but I'm inclined to agree with you. Great. Lovine Robinson asks, Rob, are there any plans to increase the 50-cent dividend payment?
So our we have a number of priorities, right? So the first thing we, as I mentioned, we're doing is we have to manage our overall, just our cash and our debt management. And so that's the first priority in there. The next piece for us is continuing to increase on our earnings, so that we can increase the dividends. What we are committed to doing is making sure that dividends are a core KPI for us. So it's not something where we just want to grow the business
Right.
without growing dividends. So put another way, let's put some numbers to it. Kind of mentioned we should be about a $20 billion a year company, and like to get that actually a little higher to about a $25 billion a year.
Attributable to
shareholders.
Good deal.
So what that is that becomes $8 to $10 per share on net income, attributable to shareholders. And that at a 50% payout ratio is kind of what we've acknowledged we should be, is that would mean that we'd be paying out about $4 to $5 a year. So if you're looking for where we're looking to go to, we're looking to go to about $25 billion, go to about that would be a little north of a 15% ROE, and at that rate we would be performing where we'd be performing in line with where a business like ours should be, and the dividend at that point would be in the $1.25 per quarter range. Now, to be clear, we're not there today,
Right.
But that's the trajectory we're on, and you've seen where we're coming from. Where we are today at $4.5 billion a quarter, so around $18 billion a year, and we should be able to make that movement towards the $25 billion. And our commitment is that as we do that, and these debt raises that we've done are term out or lengthen our maturity profile in our debt, then we can be very safely just paying a very regular dividend, and we should be able to be paying about $1.25 of dividend, and that would be, for our business, that would be a reasonable performance. Not a great performance, but a reasonable performance.
Yep, good deal. I would agree. And I'll tell you, at $25 billion and $10 EPS, it's like $120 stock. So I think, Louvain, I'm more interested, personally speaking, and I think most of the market is, of seeing the capital appreciation. And so, a lot of folks invest for different reasons. I think the main focus is to get capital appreciation. And then if you get good dividend income from that as well, too, that's a bonus. But the capital appreciation, for me, is a bigger priority. So if I were giving advice to NCB, and I'm not, I would be more focused on building up the profitability, getting to the $5 billion a quarter over the next 4 quarters, because the capital appreciation that's going to come to the market would dwarf the dividend yield. So, okay, I want to get a 10% dividend yield, that'd be great. But if I get 50% or 100% capital appreciation, Malcolm, I'm even happier, right?
Yes.
Like, I'll forgo the dividends. Like, I forwent the dividends on Carib Cement for 8 years because the stock moved from $12 to $80. Like, I didn't care about dividends. I was more focused on the capital appreciation. So dividends are good. But I think NCB is a recommendation for me, mainly because of the potential growth in the capital appreciation. And I think it'll be a top 5 dividend paying stock. But, for the most part, if you're really strongly focused on the dividend yield, and go buy Carreras, you're not going to get the capital appreciation, though, but you'll get, 8% dividend yield. Well, now that the stock's run up to $14.50, that dividend yield probably is going to be a little bit compressed. But thanks for that. Good question, Lovan, and Rob, we appreciate that response as well, too. I think that's quite good. And I think you probably have other shareholders who take the dividend payment thing seriously as well, too. So I'm not worried about that. Again, I think we would just love to see the business doing $4 or $5 billion a quarter, and I think the next 2 to 4 quarters will be the test of the pudding. Did I get that right? Did I get that expression right? Yeah, the proof in the pudding. So we're looking forward to having you guys back. And we Malcolm, Rob, we're grateful that you're willing to come and sort of face the questions from the folks, and we appreciate that. Okay, Roswell Campbell, when NCB is going to trade high at $75 or higher, we want to know that information et cetera, et cetera. So I think we just kind of spoke to it, Roswell, in a sense, right? I think the main market at 8 times is super cheap. And I do think as interest rates, stay where they are, they could trend lower. Over the next 2, 3, 4 quarters, we're going to see PE multiples going up. I fully expect a premium company like NCB to be trading at 12 times PE eventually. Rob just mentioned the path to getting to $10 EPS. And so $10 EPS multiplied by 12 times PE means a $120 stock. So that's the potential of NCB over the next 4 to 6 quarters. And I kid you not, it's like simple math. They do $5 billion a quarter, interest rates stay low, PE's trend to 12 times, it's a $120 stock. And so that's the potential of NCB over the next 4 to 6 quarters. And I think we want to see the profitability over the next 3 or 4 quarters. So we'd want to see them consistently hitting that number to be convinced, and that would deal with the market perception and eliminate all of these concerns. I also think a lot of folks felt like Patrick and Dennis leaving meant the end of the world. I don't think large FI, financial institution investors, but certainly large high net worth individuals were concerned. I mean, these were gents who had 18, 19 years experience and played a substantial part in the development and growth of NCB. But I believe NCB is bigger than just 2 persons, right? It's a really big organization, especially when you include Guardian, which is now a substantial part of the NCB financial group. It's much bigger than just any 2 persons. And while their contributions were magnificent, don't want to underestimate or not give them fair credit for that. The bank has really evolved into something much bigger, and I'm certainly satisfied with the expertise and experience that MLC has brought to the table. And so we just want to see the bank continue to do well and sort of prove out itself over the next 3, 4 quarters. And I think if our expectations are correct, this stock, I mean, even moving from $47 to $90 is, like 100% growth. So I think there are very few stocks in the market trading at, this kind of low price to book that have the potential of NCB. I think Grace Kennedy's a great buy, but it ain't trading this cheap, and I think, that's a very unique opportunity that you get in NCB. Philip Burgess. Hey, Philip, haven't heard from you today. So how's the pipeline for IPOs and rights issues from the capital markets this year? So we don't have Angus on today. I don't know if you can speak to that.
We don't have Angus on, but if he were here, he'd tell you that the pipeline is very strong. It starts with the IPO we have in the market now, and
is that Trans Jamaica?
That's Trans Jamaica.
Okay, very good.
And then and Angus. 2 things. One is the market's coming back,
right, for sure,
and we do have a number of companies that are interested in coming to the market. And on the other side, I'd say from an NCB perspective, Angus, so sorry to use it by name, Angus is committed to bringing the capital leading the capital markets back in Jamaica, bringing back the stock exchange, bringing back the activity that we all saw a few years ago.
Good deal. And I look forward to that. So I'm really excited to hear the budget read this year. We talked about asset tax, for instance. This was a temporary tax, right, Malcolm?
Should have been.
It should have been a temporary tax. And we would love to see the government of Jamaica reducing this asset tax, right?
Yes, and it should have been cut in half in 2020.
That was the promise.
As well. Yeah, that was the promise.
So imagine if they reduce that asset tax by 50%. That's $1.3 billion gone right back to your bottom line,
Exactly.
Right? So, and that's a promise that was made. And so we hope that the government will keep its promises.
Yeah, it was, if you think back in time, Dan, NCB would have been the largest party to exchange debt when the debt exchanges were done. So the financial industry was the party that actually was facilitated the debt restructure, and and then the asset tax came on to help with debt servicing, and the combination of the two things has really helped the country, because our fiscal position, Jamaica's kind of the envy of the world in terms of the fiscal turnaround.
100%.
But a substantial portion of that weight was borne by the financial industry in the context of the debt exchange as well as the asset tax. And the whole idea is, that the asset tax is temporary, so that you get through that bridging period, and then you need interest rates to be lower, the asset tax gone, and then the whole debt restructure model works the way it was supposed to, and so it's time for the temporary to not be to be temporary.
Exactly. And I think it's coming. I really do think it's coming, because where we were even 5 years ago, right, when they did this, and where we are today are substantially different, right? And I think it was a necessary measure at the time, and it's great that Jamaica can keep its track record of not defaulting ever on any of its bonds. And I agree with you wholeheartedly that we sort of turn to the financial sector and say, well, those guys are making lots of money, we're going to, tax them. But now we've, really come out of the woods. We've gotten debt to GDP down to, I think, 75%. It's really on track to get to 60% over the next 4 fiscals. And so it really is time, in my view, to give back what you took away from the financial sector. I really just think it is.
And just to add, the asset tax is only on the Jamaican side of the business.
So it's just for your Jamaican regulated
Yes,
assets.
it's just on the Jamaican side. So this is the only jurisdiction that we operate in that has this significant levy. So I mean, we look forward to it going away.
Yeah, I agree.
Sometime soon. And when you look at because we have such a significant percentage of the market in terms of total assets, we look at a commercial bank here in Jamaica, which is a third, close to 40% of the market in terms of assets, then you see that we get that percentage of the asset tax.
Yeah.
Yes.
And it creates a perverse incentive, right? If they're not careful, they're incentivizing you to invest your money offshore. And I mean, you are a regional group, and so we don't want you to be raising capital here and sort of deploying it somewhere else because of the asset tax. So, Minister Williams, Favour Williams, I think you've heard us make a good case for that. And great question, by the way, on IPO pipelines, Philip. And again, I keep saying it. The 750 million threshold should be kicking in any second now for the junior market. And so I think with them increasing that threshold for the junior market, we'll see more junior market IPO activity as well too. And so that would be good, because the 500 million threshold is 11 years old now, and with inflation, it really needs to be increased. So we look forward to that. Daniel Ferguson asks a question: with Guardian trading below $300, what are the plans to generate interest in the stock and increase the share price, having come to market at above $700? So, that's a tough one. Rob, what do you think about that?
Guardian, the Guardian stock price actually really puzzles me. Other than probably the some of the pressure is actually the cross trading. That hurts that creates a pathway out of currency flows. But otherwise, Guardian really puzzles me, because any investor in Guardian knows is fully aligned with the controlling shareholder of Guardian, which is NCB Financial Group. And so the performance is good from a dividend perspective. We're aligned in terms of ensuring that Guardian also pays its dividends up to NCB Financial Group. The IFRS 17 transition is behind us. I think it really is, Dan, what you described earlier, a bit of a sentiment issue.
Yeah.
And the sentiment issue in Guardian has to deal with a lot of the insurance industry. It's just that for a couple of years now, it's very hard to understand the profitability of the insurance company. So they're volatile, and so our goal is just start getting that core recurring insurance service results showing up. We've had the benefit of global stock markets performing well, and that has helped the performance of Guardian in the last quarter, and we'll probably hurt it a little bit this quarter. So we've had we've had that, but other than that, we're seeing a steady growing insurance service earnings, which starts to look more like a core recurring earnings growth and gets past that volatility. That was the benefit of moving to IFRS 17.
Right, right.
But the transition to IFRS 17 has been very lumpy, and I do hear from a lot of investors when I talk to them, they'll just say, I just don't understand. I
Right.
just don't understand it. I can understand the bank, but I don't understand the insurance company. And our goal is we're doing a lot of work right now to try and make the insurance business more understandable to investors, and hopefully that'll address some of the sentiment issues.
Yeah, I have to say, Malcolm, and I'm sure you'll agree with me, when I started my accounting journey 30 years ago, NCB's financial statements were probably 14 pages. Today it's like 140, and the
It's more than that.
accounting has gotten so complex.
Yes.
You need a degree just to read the financial, an accounting degree, I beg your pardon, just to read the financial statements. And IFRS 17 certainly hasn't helped. So I think that's why, in simple terms, we like to try to break it down. We really want to watch performance over the next 2-3 quarters, and see, keep it simple, the EPS and the profit attributable to shareholders hitting certain minimum numbers. Having said that, though, Rob, the growth in the insurance segment has been really phenomenal. I mean, it's amazing. Having adjusted year for year and done the restatements and whatnot, the growth in the insurance segment is simply phenomenal.
Yeah, the insurance business is doing really well, and it is the core recurring earnings that are growing. Because of the nature of the insurance business, for those who don't understand it as well, is you have your insurance results. So you basically you take in premiums and you pay out policy claims, and you have some operating expense. But then what you do is, because you take the premiums first and you pay the claims later, you earn money on the what we call the float, and that's an investment return. So that tends to have some volatility to it, but the underlying core insurance earnings should actually have very little volatility to it, and that's what we're seeing in Guardian right now, is the core insurance earnings are growing nicely, and we expect to see that curve up. In the last couple of quarters, we've had the benefit of the US stock markets, the global stock markets have helped out, so it's looked a little bit better. But while that tapers off, the core insurance earnings are growing, and we expect it to be a much more steady performance. And like I said, the growth rate is very good right now, and we expect that to continue for the foreseeable future on the core recurring insurance earnings, because the CSM that happened, or contractual service margin, that we had to record in IFRS 17 moved a lot of our equity into a liability. That starts to work its way back through profit back into equity, and as again that'll start to go up over the next number of quarters. So again, the future of core recurring earnings in insurance looks good. You might see a little bit of volatility depending on how the global stock markets perform.
Yeah, but and to underlying premiums, I do think in general, not just in Jamaica, throughout the Caribbean, folks tend to be typically underinsured. And so I think as the economy improves, certainly in Jamaica, it's typical that you see people actually utilizing insurance services, or a suite of insurance services more. So you start to buy more health insurance, improve your life insurance, your basic house insurance as the housing stock market expands. So the potential for expansion in the insurance space, I would say, Malcolm, is huge when you consider the trajectory of Jamaica over the next decade, with this huge investment in infrastructure and housing improvement. Almost always, sort of insurance income should be falling, that you would think, yeah?
Yes.
So I think the outlook for insurance in Jamaica is going to be, pretty great. And then on the pension side, and you guys are, largest pension managers in Jamaica, again, under pensioned, right? Maybe only 10% of
It's
the
a very low
workforce.
penetration.
Very low penetration. Maybe 10% of the workforce has access to pension. So it was great to see the tourism minister pushing for a tourism pension fund, because so few Jamaicans have a safety net in the form of pension. We're talking about 10% of Jamaicans actually are actively saving towards some kind of pension. And so it shows you the huge potential for growth in that space. And once again, NCB is sort of one of the largest players in that space as well too. So while the banking space is fairly competitive, I'd really like to say that, and here at Mayberry we experience this. We're a broker, an investment bank. We're not a core bank like you guys. When you're trying to get pension business out of somebody, you know what I mean? They like, what's your asset base? How long have you been around? How long have you been doing this? And so it's really near impossible for us to, compete against the Sagicors and the NCBs and the Scotia banks who've got, 50-year balance sheets, $1 trillion in assets, and several $1 trillion of funds under management. And so I think the future for NCB looks really bright. As big as you guys are, I think the room for growth is still substantial, and using your balance sheet, your experience, and your brand, I think makes you guys really poised for growth in that area.
And just to,
Welcome, go ahead, Sean.
yeah, and just to add, since we were talking about Guardian earlier,
Yeah,
that Guardian operates in more than 21 countries, more than 21 territories,
Yeah.
and looking to expand not just in Jamaica,
yeah, all throughout the region.
but throughout the region in the
Yeah.
southern Caribbean, and also in Europe as well, in terms of Netherlands. So and when we talk about, and just to go back to IFRS 17 in terms of the impact, and it would have had that initial impact at the start.
Yes.
But the business is trending back to pre IFRS 17 levels in terms of profitability, but would have taken the initial adjustment at the beginning. And as I'd have indicated earlier, if you look at just quarter over quarter, life, health, and pensions up 28%, and general insurance up 18%. So we see the positive trajectory there in terms of Guardian as well.
Yep, and that's huge because these are not one-off things we're talking about. This is usually recurring transactions, and so this demonstrates that you've grown the business, and we would imagine that it's going to be recurring, and then the potential for growth we're saying is just so huge all throughout the region, not just Jamaica. I think the potential for growth there is really huge. Okay,
If
go
I
ahead.
can, Dan,
Please,
yeah.
Rob.
So
Yes.
since you talk about the potential for growth, because that actually cuts to the core of our overall strategy, and so the first part of it is with folks like Mayberry.
Yeah.
It's about creating wealth. It's about attracting savings, attracting investment, and helping investors to create wealth. And I say that, and our chairman will say it, is that banking, insurance are kind of like commodities. Wealth creation is the differentiator. So wealth creation is important, and the reason I say the other two are like catcher's mitts for
Yeah.
us,
Yeah.
is that the more assets people have, the more wealth they have, the more income they have, the more insurance they need.
Yeah, exactly.
And so the virtuous cycle for us is get the wealth growth engine happening in the country, happening in the region. And when that is happening, the banking and the insurance sides, we just have to be brilliant at the basics, service it well, and the rising tide lifts us up and gives us a long growth trajectory. But the key to everything is actually it's actually all the investors and it's all the pension funds growing their wealth, and it's the firms that help them grow their wealth performing. And when that all happens, the rest of our business will just naturally rise.
Yeah, it's like a virtuous cycle, and that's why I'm excited about Jamaica, and why I said I want to hear the budget. It's like I'm really looking forward to hearing it because I really do think we're poised for substantial growth, and we've been really prudent for the last 8 to 10 years at the macroeconomic level, and we see unemployment at all-time lows. Interest rates are trending back down. Monetary supply is going to be increasing again. And it's just this elusive growth that we've been sort of struggling to capture as an economy, as a country. But you have to think, doing all the right things, it's going to happen. And as it happens, we are going to create a lot more wealth. And I think with that, then the bank is poised well to do well. All right, let me take 2-3 more questions. Believe it or not, we're out of time, and 5 minutes is, oh, how time flies when you're having fun. And I want to tackle this one, Jerome, because we talked about Guardian stock price, and Jerome saying you guys need to have a stock split, and if you had a stock split, that would solve the problem. And a couple of people are agreeing with Jerome online. No, I'm going to disagree. I mean, I appreciate that to some people, no disrespect, smaller investors, it might matter. But to the large financial institutions, the large folks analyzing the situation, they don't care about what the absolute stock price is. What we're interested in is looking at the stock price relative to the earnings, calculating the PE and the price to book. And so a stock split's just sort of a thing you do to change the stock price. But if all you do is half the stock price and a double amount of shares, it doesn't change the EPS. It doesn't change the price to earnings. It doesn't change the price to book. And we go right back to the fundamentals. So I don't buy NCB just because it's $47 today and it was $90 5 years ago. I'm buying it at $47 today and recommending it to you guys at $47 today because the PE is 8 times, 20% below market average, and the price to book is 73.73, which is like 40% below its peers. So it's not the absolute price, although I get it. You sometimes look at that absolute price and get, excited about it. But until you've done the analysis, then I don't think, that's the case. Let's look at Sagicor Select F. Are you going to empty your piggy bank and go and buy it because it's 45 cents? Hey, it's a penny stock. Go and buy as much as you want at 45 cents. No, you're going to analyze it and say, what does that 45 cents mean? Is this a good buy? I don't know. What's the price to book on it again, even at 45 cents, et cetera, et cetera, et cetera. So stock splits like smoke and mirrors, but I think when you unveil the smoke and mirrors, you still want to look at the economic substance behind it and then make your decision. So I personally don't think a stock split's a good idea for a company with $200 billion market capitalization, because it's not going to be moved by the few folks who get tricked by that. It's that price will move by large financial institutions making serious decisions after analyzing the entity. So it's just my view, just my view on it. Humbly, guys, the stock split won't work. It's got too big a float. It's too large a company for it not, and it certainly won't change Michael Eachin's view about are we going to buy more Guardian stock. It won't. So just remember that stock split only happens when you change the actual float of shares. It does not change EPS or PE. Am I right? You think, Malcolm?
I agree.
Fundamentals.
Yes. Doesn't change the fundamentals of the company.
Doesn't change the fundamentals.
Malcolm needs to say that because he did the analysis.
There you go. I didn't even know that. But it's a real thing. So stock splits are scams. They don't really change the price of rice. What changes the price of rice? And again, if somebody gives me the affordability issue, you know what I mean? I'm gonna buy one NCB at $47 faster than I'm gonna buy Select F at 47 cents. That's just the reality. If I think NCB is a better buy. So just my view on that, guys, and appreciate your input. It's really always welcome. And with that brings us to the end of today's discussion. Time ran out. I only asked half my questions. So Rob, you got to come back next month when the results are much better. And you can bring both Angus and Malcolm. I'd like to thank our viewers for tuning in and for their support, as always, which is greatly appreciated. Big thanks to Malcolm and Robert for coming in and being a part of the show and for sharing their insights. Your contributions are, extremely appreciated. Folks, if you're curious about updates on our virtual investor forum, then find us on social media. We share our live stream dates and our upcoming guests on our official social media pages. So give us a follow to learn about all things forum related. And join us again this Thursday as we'll be looking at S-Field's results, and we'll have Gary Parrott, our very own Gary Parrott, on the program. Don't forget to subscribe to our YouTube channel, Mayberry Investments Limited, and click the bell to receive all our notifications. Well, remember, wise investors, slow and steady wins the race. Keep safe, everybody.
At the NCB Financial Group, we pride ourselves as nation builders, committed to driving growth and creating pathways to wealth for those we serve across the region.
Each commitment that we make to you is in support of that journey. A year ago, we embarked on a turnaround to return NCB to where it was, achieving global standards for all our stakeholders. More specifically, we committed to improve our customer experience, reduce our cost-to-income ratio, increase our return on equity, and pay regular recurring dividends.
A turnaround is challenging in a good economic context. It is even more challenging in a period of high inflation and interest rates and a slowing economic context. But we are proud of the fact that we have made substantial progress against our commitments. Today, our customer experience has improved, most recently evidenced by another holiday season where we met the Jamaican public's need for cash. Our cost-to-income ratio has decreased drastically from 87.4% to 73.6%, and we are focused on reducing it even further. Our capital optimization strategies have yielded capital ratios that exceed regulatory requirements, and we now have a return on equity of 8.5%. What does this mean for you, shareholders? It means that with a keen focus on efficiency, governance, and customer experience, the financial institution in which you have invested has generated a net profit of $21.6 billion, equating to growth of 180% year over year. A truly remarkable financial performance.
Innovation has been key to our success. Whether through digital transformation or sustainable practices, we continue to redefine industry norms, ensuring access to finance and financial services for our customers.
We are not stopping here. We will continue to streamline operations, enhance governance structures, and prioritize customer-centric solutions to bring our collective vision and wealth creation goals to life.
Strong financial performance must be complemented with good works. Through the NCB Foundation and a myriad of other initiatives region-wide, we continue to empower the communities in which we operate. Thank you to our strategic partners and individual donors who supported our Build a Better Jamaica Fund, allowing us to raise $395 million for the restoration of lives and livelihoods after the passage of Hurricane Beryl. And thank you to our customers, whose business allowed us to contribute 1% of our profit to developing mindsets and skill sets that will build a better and brighter future for us all.
As we reflect on the past year, and as we celebrate our collective achievements, we look ahead with confidence. We remain resolute in our mission to connect people, businesses, and opportunities to build wealth and make lasting and meaningful impact throughout the region.
Thank you.